George, I want to begin with you. What is happening with loans right now, is it anything more than just saying, you know what, leveraged loans, I don't want floating rate right now. Rates are going one way, they're going lower. Is there anything more than that?
There's more than a rate story. I mean, there's a component of it, but there are some signs of stress within the leveraged loan market. And that's sort of the headline bad news. The underlying story is it tends to be concentrated in specific sectors and very specific vintages of when these loans were originated. Late 17, early 18, energy-related notes, maybe some retail-related notes. These were sort of cuspy credits when the loans were made. And then that loan, that company, if they miss on earnings, those bonds go from 90 to 60 in a flash. And it's the reality of how, what the quality of the underwriting was back, sort of a year or so, 2 years ago. And that's what's starting to bubble through. Now, a lot of the challenge is that there were a lot of loans that were originated then, and so it's a relatively sizable group of companies. And so you take some weakness in the energy sector, some consumer-related weakness on a bad vintage in a big series, and it looks bad. And there are some challenges, but it's not as systemic as people think.
You mentioned 2017 and 2018, and I think it's important for our viewers out there that maybe aren't too familiar with the fixed income market. This might sound counterintuitive, but it was when rates are going up that some of the bad issues really came to market, and it was in leveraged loans because people wanted floating rate. Rates were going higher at the Federal Reserve.
That's exactly right.
And that's what I want to talk to you about.
Yeah.
That specific pocket, the amount of debt that came to market, possibly placed too richly and with very little covenants around them. Is this a problem that's brewing now? Are we starting to see this materialize?
Well, you are. I mean, if you look at, say, the downgrade to upgrade ratio, downgrades are within, say, single B and below loans. So these are the riskier parts of the loan market. You have an upgrade downgrade ratio of 3 to 1. Sorry, downgrade to upgrade ratio. So there's some fundamental weaknesses that are emerging in this sort of basket of companies. But the market's very, very, what we would call bifurcated or segmented. If you just sort of go up in quality or away from that particular vintage of issues, prices are holding pretty steady, the companies are functioning, those loan covenant packages are a little bit stronger. There are sort of places to go, within the loan market, and loans are inherently illiquid, so migrating your way into those positions, it's not an easy trade. And we talked about repo and liquidity in the broad market. You try and do that in an illiquid market, and it all gets accentuated.
Andy Chorlton?
Yeah, I think you mentioned the demand for the asset class back in 2017. When you get an excess of money chasing finite opportunities, quality is compromised. And I think the one thing you can take from what's happening in Europe at the moment, where we've had low negative rates for a long, long time, it doesn't excuse bad companies with bad balance sheets. So not bad companies, sorry, it's the bad balance sheets, not the bad companies.
Right.
And I think that's the thing that's going to come to bear. And when the quality is compromised because of that technical mismatch, problems are going to arise.
We're starting to see those cracks right now. I guess to take this one step further, George, whether we're seeing this problem just in leveraged loans or more consistently across the fixed income universe.
Yeah.
Are you seeing it bleed across?
You are. I mean, if you look at, say, triple Cs in high yield, you'll see some pressure. There are a lot of stressed energy companies that specifically sit in the triple C universe. Also in the CLO market, again, there's that segmentation. The lower rated parts of the CLO market have come under pressure, but also, there are different qualities of managers. So the managers that maybe just launched at that particular point in time when those loans were being originated hold pools of loans that are, basically experiencing more risk, more challenges than others. So it manifests itself. The loan market is pretty broad, very deep, and kind of spans across, a wide range of industries, companies, and managers. And you can sort of see where the weak spots are. And I think that's sort of what's coming through right now.
What's interesting at the moment, Michael, is at the index level, across a whole range of asset classes, you don't really identify too many problems until you lift up the lid, have a poke around, and once you've had a look, you start to see some cracks and some nerves.
Yeah, and I think that's part of this divergence story from the very lower quality, this huge escalation in issuance in leveraged loans coupled with weakening standards. if the economy is going to be in 2020 and beyond sort of what the equity market and broadly speaking the high yield market are sort of saying, it's going to be maybe a 2% growth, 2% inflation environment, more of what we've seen, then probably the damage is going to be pretty minimal. But if the Treasury market is right, if you will, right, and it had been telling us, maybe not today, but it had been telling us that it's more like a 1.25% story next year, with a higher chance of some sort of recession. Then that's when you really need to be in the higher quality stuff. And I think that's why this divergence is going to be continuing, because we just simply don't. No one knows, whether the equity and credit markets are right broadly about 2020, or whether the Treasury market is telling us something that we don't know.
What's the market call, George?
Well, when you look under the hood, the market call for us is that, do you want to own one single B loan at LIBOR plus 450, or do I want to own a triple B tranche of CLOs at LIBOR plus 400? Where you have diversity, you have a much broader range. And so, the market call for us is that, there's the up in quality bias is likely to persist as this shakes out, but the value argument across the market is starting to emerge. The advancement, the one nice thing about rating cycles is that you do ultimately work through them. We're in the eye of the storm right now, especially going into year end when liquidity is thin. Being a liquidity provider at a point in time where, quality is somewhat compromised, that's the value trade.